Good evening, everyone. Welcome to our sixth bigger event of the term. Today, we are going to be discussing clean energy financing. In 2020, despite the disruptions caused by the COVID pandemic, companies, governments, and households invested a record 500 billion USD in decarbonization, up 9% from 2019. This includes 60% on renewable energy capacity, 30% on EVs, as well as 10% on energy efficient heat pumps. So when it comes to sustainable financing, green bonds also hit a record issuance of 300 billion USD. Meanwhile, when we look at clean energy stock indexes, they easily doubled over 2020. Central banks are also doubling down on climate action, in part due to a social responsibility, but also more so from a risk management perspective. Actions taken can include requiring climate risk disclosures, stress testing against climate scenarios, as well as incentivizing the banking sector to offer green loans. So, to talk about trends and opportunities in this space, we are very privileged to have with us Peter Dickson, a founding partner of Glennmont Partners. Glennmont has more than 2 billion euros in assets and is the largest fund manager in Europe, looking exclusively at clean energy infrastructure investments. Peter himself has extensive experience in the renewable energy industry, and over the past 20 years, he has worked on development, construction, as well as acquisition of renewable assets. He has also done policy work with the UN Development Programme. As always, feel free to drop any questions you have in the comment section. With that, I'll hand it over to you, Peter.
Thanks, Sylvester, and good afternoon, everyone. I just wanted to say thanks very much for the opportunity to talk to you this afternoon. I'm flattered by the introduction, so thanks for that. Let me say a few things a little bit about Glennmont. When Glennmont came together, there's four partners that owned Glennmont. We came together in 2007, and at that stage, there wasn't the same sort of flow of institutional capital into the renewable energy space, and it was a growing opportunity, and we timed our approach very well. It was right in the middle of the financial crisis. The banking crisis was underway. We actually came to find that was an advantage for us. We were able to raise capital and invest capital. We raised what was at that stage the biggest ever pure play renewable energy fund. And the reason for that was the unique opportunity that renewable energy gave to institutional investors. And actually, that's probably going to sort of underpin a lot of what I'm talking about this evening, that people are investing in renewable energy not purely because of altruistic or environmental reasons, but there are other drivers that sit behind it as well. Specifically, I'll move forward a little bit, and then maybe we can get to that a little bit further. I'm going to spend probably about 30 or 40 minutes running through this. It's quite a few slides, but I'm going to try to sort of pick out the key points. And the message that I'm going to try to give is that there are a number of complementary drivers that come together and offer renewables as it's a unique time for renewables, and renewables offers a unique opportunity for institutional investors in this case. And I'll talk a little bit about just how we've done that. So over that period of 13 years, we've raised 3 equity funds. We've also raised a credit fund. Every fund that we raised got bigger than the previous one. The first one at 437 million euros was, as I say, the biggest ever renewable energy pure play infrastructure fund at that time. And what I mean by infrastructure fund is that we don't invest in listed equities, we invest in the assets themselves. So we take direct exposure to the generation plant. So we buy wind farms, we buy solar plant, and we buy biomass stations. And we operate those, and the return on investment comes specifically from the sale of electricity. So we own the assets and sell electricity to whatever off-taker we're going to work with. Now that offers a unique set of opportunities to the investor. Primarily, what they're looking for is something which gives them steady and stable return on investment. Now, another thing that aligns to offer that opportunity just now is that in the wake of the financial crisis, we have had record low interest rates globally for the last 10, 15 years. That means that there is not a steady and stable yield from fixed return instruments like bonds, global bonds, gilts, and so on. So institutional investors are looking for alternative ways of getting that same steady and stable return. Now, renewable energy brings that, because certainly in the first half of the period since we set the fund up, renewables were backed across Europe by feed-in tariffs. That was fixed price with no price risk associated with the yield. The assets themselves were primarily proven. Wind farms worked. They'd already been working for 20 or 30 years before that. The same with solar. There was very little technical risk associated with the assets. So by investing in renewables, they were able to take a low risk investment, offering steady and stable returns with very little pricing risk associated with the output. And that gave them something which was very close to a fixed return asset, a fixed yield asset. And that gave them an alternative then to the sorts of investments that they had making before. Similarly, at the same time, of course, climate change was growing in its importance, and over the last 15 years, that has grown in relative value as a driver. And the third point, which drives renewables, is energy security. Europe, along with Japan, are the two biggest net importers of primary energy in the world. Europe imports about 85% of its energy needs, and at the minute, Japan is importing about 90% or more than 90% of its energy needs. Now, that itself creates a big driver for investments in renewables. And obviously, wind and solar is free, and there's no supplier of that. And the more of your own energy that you need for you to meet your demand that you can generate from such an auto-generated technology, the less you have to import from what are primarily fairly risky areas of the world. Most of the energy is produced by the former Soviet republics or from the Middle East, and that's seen clearly as a political risk to countries. So that's really what the drivers that sit behind it are. Now, what we did over the past 13 years is we've invested in a series of assets, and you can see on this map just what we've done. It's onshore wind, solar photovoltaics, bioenergy. Bioenergy has all been in the UK. These are complex assets, and our team is UK based. We've invested in solar across southern Europe, mostly in Portugal and in Italy, now in Spain, and we had some in France as well. And onshore wind has been more diverse, with investments from Finland, Republic of Ireland, UK, Italy, and France for that. And now we've invested in offshore wind. So we own 25% of the Gode Wind project, which is 330 megawatts of offshore wind in the Baltic, and we're continuing to grow from here. So the diversification that you see across the different countries of Europe and the diversification across the different technologies also gives stability of yield. And as I say before, if you go back to what the investors are looking for, it's that steady, stable yield of financial return is primarily what the investors are looking for. Some of the highlights of what we've invested in, I mentioned already the Gode Wind offshore wind park. That's our first stake in offshore wind. We didn't invest in offshore wind in funds 1 or 2 because we believed that there was still nascent risks associated with the technology in those early stages. But by the time we came to our third fund, the largest fund that we've raised at 850 million euros, we believed that offshore wind brought the sort of performance that the investors were looking for. So we've taken a 25% stake in this wind farm. So Catavento wind park, solar park in Portugal, was, I suppose it was typical of the opportunistic approach that we took at the height of the currency crisis, which followed the banking crisis of 2008, 2009. Portugal was viewed by many as one of the pigs, the Mediterranean economies that were seen most affected by the financial crisis, and many people stopped investing in Portugal. We invested in a number of solar parks in Portugal for reasons that we had strong reason to believe that the solar sector of Portugal was going to be immune to the currency crisis that was on the way. We were proven right, and we made a very good return on all of these Portuguese solar parks. The Serre onshore wind park is mostly in Sicily and southern Italy. It's 245 megawatt portfolio of different wind assets scattered across the island and across southern Italy. And that's one it was the largest investment that we had made at that time, and we had co-invested along with one of our investors in that park. And that has been a highly successful portfolio that also brings us an operating team who are based in Palermo and in Rome. And in the UK, typical of what we do in bioenergy, we invested in the Sleaford biomass plant, which was burning straw, the co-product of the production of wheat and barley in the east of England. Now, this was a delightful project. It's 40 megawatts of straw-fired generation. The fact that it's combustion-based means that we also produce heat, and we were able with this project to give the heat away for free. So the 39 megawatts of electricity was passed to the grid. The heat that was produced, which was up to about 10 megawatts of heat, was piped on a private network into the village, and that provided free heat for primary school, municipal council offices, sports halls, swimming pool, football club. All were heated for free from this project, and we won community engagement awards because of this particular project. The investors that we have are global. They're all institutional investors, which means that they are all pension funds and insurance companies, and a few large family offices invest, but mostly it's pension funds and insurance companies, and they are able and keen to invest big ticket items. So they come from all over the world. They're all eager to take exposure to European renewable energy, and as you can see from this spread, that's a very large amount of investments coming in from Japan, from the United States as well. But the most of our investors are European investors taking exposure to their own area. Now, if I look at some of the drivers that sit behind it, I've skimmed across it already, and I've talked a little bit about what it takes to invest, or what the reason to invest in renewable energy is. But let me look a little bit at some of the other drivers. Now, renewable energy is, of course, a political priority. Nobody can miss that fact. It's driven, climate change is coordinated globally by the United Nations Framework Convention on Climate Change. The process of the conferences of the parties, the COP and MOP series of meetings, established the goals. COP21 in Paris in 2015 created a legally binding treaty on 187 countries that binds them to take steps to reduce carbon going into the atmosphere. Now, that itself has been distilled down to this target of reducing global warming to 1.5 degrees Celsius. Written into the contract is 2 degrees Celsius or less, and all of the targets that people set themselves are established in order to contribute as much as is possible to that target. Now, this year we've got to COP26. Since the COP21 in Paris, there has been something of probably a mixed fortunes of the process. But we have established that this year in Glasgow there will be COP26, where we do intend to build very strongly on the actions that have gone before. And you will have noticed, of course, that many countries are now establishing a net zero target by 2050, and we're seeing some huge steps towards that from the UK, from the European Union, from China, and Japan and South Korea are building into it. And now, of course, we're delighted to see that the United States has rejoined the process, and will be moving towards also establishing some challenging, we hope, targets to reduce the carbon in the atmosphere. Now, of course, that condenses down and starts to become something closer to an investment case for a fund such as ours. And if we look at where some of the gaps exist at present, now, if we were to sit on the current pledges and the current targets, we're not going to get anywhere close to the target. As you can see from the graph here, we will continue to have emissions that will steadily rise at the end of the COVID crisis. In order to get to a 2 degree Celsius consistent target, which is what we got from COP21, there needs to be a very significant reduction of carbon in the atmosphere. And if we're to get to the aspirational target of 1.5 degrees Celsius, there needs to be an even more dramatic reduction in emissions. And that's why it's a very, very challenging target that has to be met. Now, if we look at that in terms of industry segments, now the power sector, where renewable energy sits, is the largest part of that. 34% of the emissions in 2018 came from the power sector. And I would say that that's probably the easiest sector to manage. Road transport with vehicles is 18% of that, and you can see as you go down from here, RCA is residential, commercial, and agricultural, which is largely low temperature, low grade heat that's produced. Aviation, steel, cement, and agriculture. You can see as you go down. We focused, and Glennmont is focused entirely on the power sector. It's the easiest. I say easiest because it's largely regulated. The assets involved in this are large capital-intensive assets where investors such as ourselves can put large amounts of money to work in individual assets that make immediate impact on the targets. Road transport is more difficult. It's much more diverse. Individual vehicles have to be focused. Individual vehicles are not regulated to the same extent as power stations. The individual investment is very much smaller. You need to change public behavior in order to change the road transport sector, and so it's much more difficult. And yet we're seeing big changes now with electric vehicles coming onto the roads in large volumes, and regulation, of course, is driving that by forcing the market to change from conventional engines to electric vehicles. Low-grade heat is much more difficult. In order to change personal behavior in houses, with the way houses are heated, cooking is carried out, light, etc. Also commercial heat, and the agricultural sector, which is very hard to regulate, is a much more difficult area. And then as you get to the more fragmented areas of individual industries, you can start to see why it's going to be very difficult to mop up the areas beyond power. And to that extent, it's almost like the low-hanging fruit has already been plucked in this sector, and we need to do something more. Nevertheless, renewables can cut of that 34%. Renewables has the potential to reduce further emissions by 70% of that. And therefore, the sector that we're in can continue to lead the way. And this is what we're aiming to do now. In order to get the reductions down to where we aim to get to, we can manage to make 70% of reductions through the use of renewables, electrification of previously non-electrical sectors, plus energy efficiency. And by doing so, we can reduce the emissions very considerably from that. Now, the European Union continues to push very, very hard for targets. And we're seeing that further targets of CO2 reductions in the short term by 2030 are targeting 55% reduction in CO2 in the short term. As far as we're concerned, we raise funds that have a 10-year life. In other words, when we raise the capital from our investors, we raise it from them. We're raising a fund this year, so that fund will be labelled as a 2021 fund. We invest that money over a 3 to 4 year period, so that will be fully invested by 2025. We build, operate assets, and then once we've optimized the performance, we sell them again at a profit because they've been de-risked. And we are obliged to return our money to investors by 10 years from when it was raised. So by 2031, the money that we're raising this year must be returned with the profit margin by 2031 to investors. Now you can see, therefore, that this period between now and 2030 is exactly our investment thesis for the fund that we're raising right now. And of course, all of our investors are very keen to watch the regulation that's coming through and watch this process, because you can see what's occurring. Now, if you look globally, you can see that there is a variation in how countries are operating globally. Many of the countries around the world are well behind their targets. And of course, this correlates very much with the countries that are the largest producers of hydrocarbons. The Russian Federation, Saudi Arabia, Turkey, United States of America. These are all the major producers of hydrocarbons, and they are pretty far behind. The European Union sits pretty much in the middle, and then you get the countries that are working much better at the top end. Everybody needs to shift to the right of this of this graphic. Now, if we look at how renewable energy fits into this and actually creates something of a recovery, then we can see actually that it fits also with the crisis that we have just now. I was going to call it an economic crisis, and actually it is, because the COVID-19 is indeed producing something of an economic crisis, where we've lost a lot of production around the world, and renewable energy actually can be seen as something of an opportunity, or this can be seen as something of an opportunity for renewable energy. And if we just look at what is coming from the International Energy Agency or from the Atlantic Council, we're seeing some very strong statements that renewable energy can provide the sort of growth that is required to see some sort of a recovery from the crisis that we're in just now. And as we're looking forward, and renewable energy starts to grow, indeed, this slump that we've seen is something of an opportunity that renewable energy can provide us with a recovery and a growth to come from this. And the pillars of that recovery are these. I'll talk about each one of these a little bit further, but it's about modernization of grids. It's about acceleration of the mainstays, the basic technologies of renewable energy, maintaining where it's possible to maintain low carbon conventional technologies, managing the conventional technologies of gas and coal in a way which is intelligent and thought through, and also, of course, drive the whole thing with ambitious legislation. Grids need to change. I remember an anecdote that I was told in a presentation like this some years ago, that back at the time of the Second World War, when there was a lot of bombing going on in London, they never actually stopped the flow of electricity. There were limited, localized blackouts, but they never managed to black out the network, and that was because the grids in those days were localized. They were interconnected. They had generation nodes at many places. After the war, and then during the period of economic recovery from the late 40s through to the 1970s, we saw a centralization of the power sector, where the power stations in the UK were centralized around the location of the coal fields. So many power stations in South Yorkshire, some power stations in South Wales, and the network was built to distribute from those nodes out to the demand at the end. Renewables is actually giving us an opportunity and a requirement to reconstruct those networks, and it's to go back maybe 70 years to the sort of networks that we had previously, where you have multiple small generation nodes all over the country, and in between those you have distribution and transmission networks that are much smaller in capacity, but much more dense in the way that they are laid. And actually, it gives a lot of security to the network in general, because if you lose one node, then other ones will step in. And that also is the response to people who say that generation from renewables is variable. It also means that if a wind farm, for instance, is not producing at any point in one part of the country, other networks can step in and provide backup and redundancy to that. And as networks start to become interconnected internationally, then you start to see that security growing further. Of course, wind and solar, which are the mainstays of renewable energy generation, have to grow. There's plenty of capacity and spare capacity to grow these yet further. And we'll talk a bit about the reducing costs and availability of these as we go forward. Hydropower and nuclear power are important. They produce no carbon whatsoever. And while there may be very strong arguments against both large hydro and nuclear power, it's not possible at present to just reduce them suddenly on the network without looking at some phased replacement of them by non-carbon alternatives. And therefore, it's important to maintain this role until we can manage a phased reduction of those technologies. Gas and coal are also important on the same basis, but there should be a migration away from coal towards gas, and a reduction, therefore, of carbon throughout. And a managed, phased approach to that is also necessary. as legislation is introduced for controlling climate impacts, we need to use regulation in order to drive this. It's not at this stage yet possible to leave the market to manage this entirely by itself, and therefore the invisible hand of the market has to be held at bay to some extent with legislation coming forward. Of course, we always see this in terms of how this impacts on our business plan, and this is all investment opportunities for Glennmont, and therefore it's opportunities to raise and invest more capital in the future. Now, the market, of course, is growing very rapidly, and the next couple of slides are going to flick back and forward between them to some extent. You can see the sorts of trends that we're seeing. So over the next number of years, we're expecting that electricity growth will be about 1.2% per annum, of which 4.5% per annum will come from renewables, and that's the International Energy Agency projection for the next 20 years that we're seeing. So very rapid growth altogether. The demand for the growth of demand is going to come from development of further industrial development of developing countries and electrification of utilities in the developed world. And energy capacity growing to meet that demand is largely going to come from renewables in that circumstance. And you can see here, corresponding to what I just said, that much of the growth is going to come from the developing countries that we have seen in the last slide. So when we're looking forward, and again, Bloomberg New Energy Finance is a media house specifically looking at the new energy economy, and they are projecting that we will see a very rapid increased share of the world generation capacity coming from solar and wind and other technologies, and a reduction of the conventional in the years going forward up to 2050. Forgive me for this slide. We use this one in sales pitches to investors, and I think the fact that we put the conventional power in monochrome and the renewables in a coloured slide, I think is a little crude, but I think you get the gist. That there's much more rapid growth at present coming from the renewable sector than we're seeing in the conventional sector, and what that's creating is it's creating an inertia in the flow of capital towards renewables. So many investors and something of a virtuous cycle is underway. As the large institutional investors stop investing in fossil fuels and move to renewables, there becomes more inertia in the growth around renewables, which means that people have less, the remaining investors for fossil fuels become incentivized to move away from it for fear of stranded assets in that sector. Nobody wants to invest in a coal-fired power station with a 30 to 40-year life, only to find that on year 5 to 10, suddenly regulation has shifted and they can no longer dispatch its power. So in order to manage that risk, that unknown and unforeseen risk going forward, many other investors are now switching to renewables, creating this virtuous cycle of investors. Now, I talked about the main drivers for investing in renewables. Now, there's climate change in particular. There's also energy security, but there's also a pure economic driver that has come into play. Now, that wasn't the case when we started investing back in 2007. Back in those days, you needed regulation as a means to promote and support the renewable technologies. Nowadays, regulation is not nearly so important because LCOE, the levelized cost of energy, has fallen so much in the renewable sector that now renewables themselves are cheaper, or power from renewables is cheaper than it is from other sectors. And this slide we use a considerable amount, and I find it quite dramatic. The reduction in cost from solar photovoltaics over the period of the last 10 years has been greater than 90%. That is a huge fall. Over the same period, the fall in the levelized cost of energy for wind parks has come down by 70%. Now, those two reductions have meant that it's now cheaper to produce power from solar or wind in many countries than it is to produce from conventional power. And I've got a slide in a couple of slides' time, which I'll demonstrate that. If you look at this as well, you'll see that other technologies have come down and some have gone up in LCOE. Solar thermal has come down by 16%. Gas peaking plants have come down. That's largely due to cheaper costs of finance. Many banks are now gearing themselves up to invest in the energy sector per se, and that benefits all production of power. Nuclear power has gone up considerably in price, and that's really due to the internalization of the external costs of risk associated with it. It used to be that governments would underwrite the cost of waste disposal from nuclear. That now has to be allowed for in the financial models at the point of investment, which has pushed the price up considerably. Geothermal, which is considered to be a renewable source of power, has gone up by 20%. Now that's really driven by the fact that the geothermal power is sourced by drilling to find the reservoirs of heat underground. The cheaper, shallower reservoirs have been exploited first. Of course, as you move forward, you have to go deeper and deeper and explore further and further, and naturally the cost therefore goes up considerably in geothermal. But this is our slide. So if you look at a map of the world and you can see where it's cheapest, what technology is cheapest where, and the colored areas demonstrate that. So the United States, most of Europe, overall the cheapest form of power in those sectors is onshore wind. Offshore wind is cheaper. Probably actually, if you can see here up around the Baltic, you can find the areas of offshore wind is now competitive with onshore wind. Solar photovoltaics are cheapest across China, India, Australia, and some of Africa. So, and of course, you still have a certain amount of exposure. Natural gas from the former Soviet Union, which of course is awash with natural gas, and therefore it makes complete sense. But of the cost of production from renewables continues to fall, this map will go green and yellow, or go blue and yellow in a larger area all the time. So the reducing LCOEs comes from increased efficiency, increased reliability, increased capacity, and the efficiency of construction and the time to the market, the flexibility that's being built into the technologies going forward, good program management, cheaper and cheaper O&M, and the consolidation of many of the providers. And actually, I would add to this, there's the cheaper and cheaper finance. And we're seeing that the efficiencies, particularly in solar and wind, are getting greater and greater all the time as the technologies develop. So we're seeing larger capacities, innovation appearing, and the time to market as being the main drivers. I'm going to move quickly because I'm aware that in time I want to talk a little bit about some of the new technologies at the end. But if I go back again to what I said at the beginning, that investors are looking for something which gives them a fixed income style return, and therefore looking at the sort of tariffs that we had to begin with. I said in the early days we had feed-in tariffs or premiums, which took the risk away from the sale of electricity. Feed-in tariffs were ideal. You had a commitment to purchase 100% of the power produced at a fixed tariff. Premiums that sat on top of the price, premiums were a fixed price, but they sat on top of the variable cost, which reduced the variability of prices. And certificate systems like we had in the UK also had protection mechanisms built into them, such that if the price was to fall, there were mechanisms to allow the increase of price of certificates to balance out the overall price. Now, I'm going to move forward a little bit. As we move from there to market-based solutions, we're now seeing power purchase agreements, bilateral power purchase agreements with large corporates like Nike, Google, Amazon, Budweiser, and more of the world now are having these fixed price power purchase agreements. That's driven entirely by the reduction in the LCOE, because now the end user of the power can comfort himself that he is getting a long-term secure source of power, which is competitive with power that's bought from the utilities. And therefore, as long as the corporates themselves have a balance sheet which allows significant security and sufficient security to underwrite the power purchase agreement, then they are seen as bankable off-takers for the power. And so we're seeing that the demand from off-takers is growing greater and greater. And in fact, the demand is now outstripping the supply of the availability of supply, which creates a further incentive to invest and develop further capacity of renewable power. Power purchase agreements can be structured in such a way that you either sell directly to the consumer from the generator, or you use what's called a synthetic corporate PPA, where you sell to the utility. The utility balances the power with its own sources of power in the background, but there is a commercial agreement between the consumer and the generator being, in this instance, us. And the financial agreement between us and them is met on a commodity basis from the utility through the grid, which allows a much more efficient and balanced approach to the management of networks. So as we go forward, I said I would like to talk a little bit about some of the technological developments. I'm a little skeptical always about technological developments. I believe that the technologies that exist right now are sufficient to decarbonize the sector. They're sufficient also to provide investors with that steady and stable return, de-risked investments, and the sort of financial performance that's necessary. But occasionally there's areas where one can improve on what already exists. We as institutional investors are a small company representing the pension funds and insurance companies globally. It's not our role to manage the sort of technological risks associated with new innovations, and therefore I'm always skeptical when new technologies and new innovations are brought to us as financial investors. I would say that the correct home for innovation is with strategic investors such as independent power producers or utilities. And therefore, I think it's difficult to look at some innovations. But innovations, nevertheless, are important. Floating offshore wind is one which is going to open up a huge amount of the market. Now, fixed bottom offshore wind, which is what we invest in these days, is actually it can only be fixed where you have shallow shelving shorelines. And many of the shorelines around the world are much, much deeper. And therefore, in fact, 80% of the offshore wind resources located in depths of greater than 60 meters. And therefore, in these areas, you need to have floating technologies. If we were to shift from fixed bottom to floating, it would open up the whole of the Mediterranean. It would open up most of North America, with the exception of the Northeast, where fixed bottom is being installed right now. The Gulf of Mexico would be opened. So suddenly you can see that the market would open up hugely. And as it says here, much of France and much of Asia would also be opened up to this area. Now, floating, of course, has different technologies. Much of the technologies has already been developed for the offshore oil production, offshore oil and gas production, and therefore innovation is limited. And there are many strategic investors who have been associated previously with hydrocarbons who understand this technology and can manage it. But you can see that the different technologies do mean that indeed there will be more dynamic loading on the prime movers, and therefore we need to consider the risks through a longer period with different set of loads associated with it. The costs associated with floating offshore wind, of course, the turbine is only a quarter of the costs. In order to put in the electrical infrastructure, you need to run that in deeper water, further offshore. The substructure and the foundation, of course, is a unique assembly for floating offshore wind, and there's a large amount of interconnected risks and elements here that need to be managed very carefully. Many first movers in this market are already moving with technologies. There are at least two floating offshore wind parks already in operation, and there are many more. The next round of contracts for differences that are being auctioned in the UK will include floating offshore wind, and we as Glennmont are already looking at partnering with some of them. We also see that the opportunity here for technical innovation will drive down the levelized cost of energy for floating, just the same as it has done for fixed bottom offshore and for onshore and solar photovoltaics. And so we certainly expect in the years to come that there will be many opportunities to invest as the cost falls. And the countries that we'll be looking at are some of the major OECD countries around the world. Another innovation is hydrogen. Now, of course, I know I'm talking to an audience of engineers and scientists. Predominantly, hydrogen is not a technology; it's an energy carrier. But nevertheless, it's an energy carrier that allows the electrification of a large amount of further infrastructure. If we were to use hydrogen in transport fuels, in commercial heating, if you remember the slide from earlier on, you can see that we can electrify and therefore move towards renewable power, many of the sectors associated. But nevertheless, there are risks associated with that. Many of the production facilities for hydrogen are themselves energy intensive, and many of them are also carbon intensive. And so we have to find means of producing hydrogen that is low carbon and proven, and also then have conversion technologies going forward that will utilize carbon effectively and cleanly. And the applications include, of course, heating, either through grid or high grade heat for energy. Chemical production, of course, is important, and energy storage. And of course, the important thing about energy storage is that if one can store energy for the production of electricity, then one can increase the penetration of variable sources of power much, much larger than we have managed in the past. And wind and solar can continue to grow because we have efficient and cheap storage of power with little losses. And I think actually at that point, it's probably about the right time to open up to see if there are any questions from anybody. I apologize that I skimmed through a lot of things very quickly, but I'm delighted if there are any questions that I can answer.
Thanks a lot, Peter, for that very insightful talk, both into kind of Glennmont's operations as well as the larger picture within this renewable energy investment. Yeah. So I do have a few questions of my own, but to kick things off, I will just take a few from the audience first. So yeah, Leo was asking, do you actually worry about the cannibalization of power prices as there are more and more renewables on the grid? So for example, solar PV is generating at the same time and you have marginal prices going to zero.
Oh, no, absolutely. I think cannibalization is one of the significant threats that we have. And you know, at the minute, if you look at the long-term power projections, we're actually seeing a rise again, but in the very long, and that sits inside the models that we have. So we're fairly comfortable that our existing models will not be impacted at the latter stage by cannibalization. But cannibalization is inevitable as we move towards zero marginal cost of production. It's an inevitable outcome, and then I think we have to start looking at new energy market models. And probably it takes us into the area of discussing energy, the provision of energy as a service rather than a commodity. But that opens up a whole new area. And I would say that as far as current investors and investments are concerned, I think it's probably beyond the horizon for them. But it's a very good question, actually, and I think it's something that the markets will have to accommodate in due course.
Mm-hmm. And I guess a follow-up from him was, do you invest in, for example, batteries to mitigate this risk?
We haven't invested in batteries yet, but yes, we will invest in batteries, and it's exactly for that reason. I think we've tried to find investment models for batteries, and it's very hard. In fact, the cannibalization issue is concentrated in batteries because batteries themselves will also increase cannibalization. So if you invest in battery storage on the basis of the arbitrage between peak and trough pricing, then of course the batteries themselves are themselves reducing that arbitrage and are cannibalizing their own investment case. However, if you were to invest in a battery as a means of optimizing the value of power produced from, say, a solar or a wind park, then you've got a better case to be made. You can trade your power with more certainty. There's less risk associated with the trade, and therefore you can increase the unit price of power produced. And that, I think, will be the model upon which we invest in our first storage plant. And I imagine that the fund that we're going to raise this year will indeed include some hybridized generation with storage plant that we look at.
Interesting. Yeah, so maybe just a question from myself. So you mentioned one of the key drivers for your funds is the stable returns, and you have actually been through countries like, let's say, France, who have transitioned from a fit-in tariff model to a fit-in premium model. So what is it like kind of dealing with that additional merchant risk in a sense?
We've actually found it fairly seamless. The long-term projections of power prices are actually rising again. We've had some wobbles, and certainly over the past year, there's been more wobbles. We've had more risk in the portfolio, more volatility in the portfolio, generally speaking. But actually, they're not bad just now. We've also invested in our Finnish investment in Fund 3 is a very large onshore wind park, which we're selling the power to Google from that one. Mm-hmm. And that's the first bilateral PPA that we've invested in. Now, that is fixed price. So 60% of the power produced from that is sold at fixed price, and that gives a lot of stability as well. So I think if you look at a portfolio where we still have some feed-in tariffs from our offshore wind parks and our legacy investments, we've got some pure merchant exposure, and we've got some power purchase agreements. On a portfolio basis, we have a reasonable amount of stability in the portfolio. But we will take further exposure to the markets as we go forward, and we'll expect these bilateral PPAs to balance that risk.
Mm-hmm. Okay. Yeah, the question from Mike, he was asking, are you confident that government policy will actually keep up with the required rate of renewable deployment? Sorry.
Actually, what I'm hoping for is that the falling LCOE makes regulation less and less necessary for individual investments. I think where I see the need for the regulation just now is to have the accelerated development to meet the targets of decarbonization and climate change mitigation. That's where regulation is necessary. Just now, for an investor, we're much less exposed to regulation than we were before, and there are already a shortage of projects. So for an investor like ourselves, I think the drive that we need is to see projects coming forward, and the current regulation that we have is sufficient for those certainly for the short to medium term, but the medium to longer term where we need that further acceleration. I'd say watch this space. Let's maybe talk again after COP26 in November this year, and then we'll see what the appetite of governments to put aggressive regulation in place is. But in the short term, I'm comfortable that regulation is sufficient.
Okay. And we have a question from Ben. So he was asking, are we actually seeing corporate PPAs becoming more available for smaller firms as they become more and more commonplace?
No, we're not seeing it yet, but I expect to see it. I think at the minute, yes, we're talking about the big blue chip companies. It's the Anheuser-Busch, Budweiser, Google, Microsoft. These are the people that are writing PPAs just now. I expect that we'll start to see consolidated PPAs of a number of investors coming in for portfolio investors, off-takers coming in portfolios. I expect to see that. I haven't seen it yet, so I think we're still in the early days. But I think the Pathfinder PPAs that have been written recently will open up the ground to further PPAs to be written in the future. And I'll just point out, don't forget that back in the 1990s, we were going through what was known as the dash for that. And small on-site CHP generators were being developed, and power purchase agreements with smaller off-takers in the paper industry, with hospitals, and so on, were quite common. So I don't think it's beyond imagination to say we'll go back to the way that you can get sufficient security and underwriting from smaller off-takers.
Mhm. Yeah, moving on to a question from Leo again. So you said that it's in kind of Glennmont's role to take on the risk associated with what is innovative, renewable technology, but yet you guys kind of earn the rewards once they become fully commercialized. So he was asking, is the current balance of who kind of takes on the risk as well as who rewards from it, is it fair? And he kind of apologized after saying that it's a bigger political economic question. But yeah, he would just like to hear your thought on this.
I think, it's funny, we had a big shift from when we came into the market in 2007 to now. We saw a shift towards institutional investors taking more and more risk in this market. And utilities fell away. Utilities were less relevant in the market through the early part of that period. We're seeing a shift back again now, and I think that's you said fair. I think it is fair. I think actually it's risk has to be taken by those who are best capable of managing it. And I think as we look at offshore wind, floating and fixed bottom offshore wind, where there are significant risks associated, I think it's appropriate that strategic investors come in and take that. So I think that what we saw in the market early on, which was strategic investors doing some of the early wind farms, entrepreneurs developing them, taken on by some of the strategics, and then financial investors came in and bought them out, and then started taking the risk from development and construction because those risks were seen to be manageable. We've now moving into the innovative area of, say, the two that I pointed out, floating offshore and hydrogen production. I think it's appropriate that strategic investors take those risks in the early days. I think that once a project has been de-risked and has been performing for a period of time, a financial investor can step in and take a portion of that de-risked, which is what happened with fixed bottom offshore wind. So we saw Dong, or forgotten the name now, and the big strategic Shell as well, doing a lot of the early development work and then selling those investments down to financial investors. I think that's the appropriate way. I do fear that many financial investors have become bullish about the market and are possibly going to take more risk than they are really equipped to manage. But I do think that the market will quickly recover, and we'll see a rebalancing of risk going to the right people. So I think that the utilities and independent power producers have got a long way to go with the development of new technologies and the expansion of the renewable energy world.
Mm-hmm. Yeah, and just a question from myself. So in your slides, you actually mentioned that you guys invest in a renewable asset and then you work to optimize its operations. So what is actually involved in that optimization process?
Well, I think it's probably best summed up what we did in the first fund. We invested in 5 separate wind parks in France. Now, in those days, we were limited to 12.5 megawatts per asset in France. But we put those together into a portfolio. We break and then re-establish the service contracts, the operations and maintenance contracts, or the commercial and technical management contracts, or the insurance policies around the portfolio rather than on individual assets. We refinance as a portfolio potentially. We optimize the performance. We extend the life of the assets in some cases. We used to invest in wind parks on a 20-year model, but we do sell them on a 30 or 35-year model these days. And we back that and underwrite that extension of life through an extensive technical survey of the parks. And once we've done all that, we then sell the parks on reduced costs and increased life and increased value and take the upside. So it's all those and any other opportunities that we can find is what we mean by optimization.
Okay. And would there ever be a scenario in which you guys are holding on an asset till it reaches kind of the end of its design life? Or would you guys always work to kind of sell it off?
No, the funds that we have at present, I mean, in future it's possible, but the funds that we have at present as finite life funds, the 10-year funds, with relatively speaking higher return expectation, means that we would never hold an old asset. We would always want to sell it as soon as the value has been optimized. We would seek to exit, which is usually commercial operations plus 3 or 4 years maximum.
Mm-hmm. And another question from the audience. So Mike was asking, are you concerned about what appears to be an investment bubble in clean energy? I guess stocks is talking about, yeah.
Yeah, I mean that's stocks, and the great thing about taking direct exposure to the assets themselves is that we every model, every valuation is backed up by the discounted cash flow to equity for the asset, so you don't get that same sort of sentiment valuation driver placing it. So not for us, although our suppliers, of course, are very often listed companies, and we have seen problems with turbine manufacturers, with companies like Nordex and Gamesa, and at different times getting into difficulties. So we want steady performance in the listed equities as well, but it doesn't directly impact on our investments.
Mm-hmm. And just another question from myself. So you guys have invested in quite a bit of projects. So have you guys seen any kind of unforeseen risk or that kind of reduces the valuation of this project? And if so, what are this kind of risks?
Yeah, I've got to say, we carry our scars as well. We've had problems with construction. Construction is a significantly risky area. I mean, many, particularly financial investors, have become quite complacent about construction risk, but it can have a very large detrimental impact. And our biomass assets, for instance, have had a tough time in construction. So I think that the contracting risk associated with construction is an area to be considered. Our investments in the UK, our funds are euro denominated. We invested in the UK before the Brexit vote in 2016, and the devaluation of sterling had an impact on valuations. It's bounced back, of course, but many of these black swan incidents that occur can directly impact on the performance of funds.
Mm-hmm. Yeah, and maybe just a last question from myself. So I guess many oil majors, they have this net zero targets, and they're kind of aggressively looking to purchase renewable assets. So is there sufficient renewable developments to meet that demand, or are we actually kind of seeing a chasing of limited supply and a pushing up of prices of such assets?
Now, at the minute, we are asset limited, and so there's many investors, and there's a lot of capital coming into the market. We need more developments to meet that. So I would say that yes, if anything, just now we probably limited in the number of assets, which is probably having something of an inflationary impact on pricing. I expect that the market will balance that out again in due course as more developers see the opportunity to come in and provide product to the investors.
Okay, great. Yeah, so it seems like that's all the questions the audience and myself have. So this will be a good time to end the talk. So do you have any final comments, Peter?
No, just thanks again, Sylvester, for the opportunity. I enjoyed it. It's a shame I've been sitting here staring into a computer screen, seeing nothing but the presentation. So I far prefer to see these things when I can get some feedback from faces. But maybe next year we can do it in person.
Yeah, that would be great. Yeah, once again, thanks a lot for giving us this very insightful talk. And yeah, have a good day ahead. And to the audience, thanks for joining us too. Thanks a lot, Peter.
Thank you. Bye-bye.
See you around.